Video script, Index Funds versus ETFs, in-depth breakdown opening. Hey everyone, welcome back to the channel. If you're new here, make sure to subscribe because today we're diving into a very important topic for anyone interested in long-term investing: index funds versus ETFs. I know this can be a bit confusing at first, but don't worry. By the end of this video, you'll be able to confidently choose between the two, or even better, understand how they can complement each other in your investment strategy. Background. Information. All right, let's start with the basics. If you're an aspiring investor, you've probably heard the terms index funds and ETFs, but what do they really mean? What sets them apart? And why are they so popular right now? Index funds. An index fund is a type of mutual fund designed to replicate the performance of a specific market index, such as the S&P 500, the NASDAQ 100, or even global indices like the MSCI Emerging Markets Index. These funds invest in the same stocks that make up the index, typically in the same proportions, with the goal of mirroring the index's overall return. Think of it as a basket of stocks that you're buying into. The big idea behind index funds is to follow the market's performance, not try to beat it. This is what we call passive investing. Historical background of index funds. The first index fund was launched in 1975 by John Bogle, the founder of Vanguard Group. He created it because he believed most active fund managers were not able to consistently outperform the market after, accounting for their high fees. The first index fund, the Vanguard 500 Index Fund, allowed regular investors to invest in the top 500 companies in the U.S. with extremely low fees, a groundbreaking concept at the time. ETFs, exchange-traded funds. An ETF is a type of fund that tracks an index, just like an index fund, but unlike index funds, ETFs are bought and sold on stock exchanges like individual stocks. This means you can trade them throughout the day, during regular market hours, and their prices fluctuate throughout the day based on supply and demand. History of ETFs. The first ETF was launched in 1993 under the name SPDR S&P 500 ETF, SPY, which tracks the S&P 500. The creation of ETFs revolutionized the investment world because they combined the low-cost, passive nature of index funds with the flexibility of trading stocks. Detailed explanation. Now let's break down how each of these works and why they're so popular today. How index funds work. Index funds are typically structured as mutual funds. When you invest in an index fund, your money is pooled together with the money of other investors. The fund then buys the same stocks that make up the index it tracks. Key points. Passive management. Unlike actively managed funds where a manager picks stocks to try to outperform the market, index funds simply aim to replicate the performance of the index. So, there's no active decision-making process involved. This is why they have lower fees. Fees, expense ratio. The fees are one of the biggest selling points for index funds. The expense ratio, the annual fee taken as a percentage of your investment for index funds, is often less than 0.1%, compared to 1% or more for actively managed funds. For example, the Vanguard S&P 500 Index Fund, VFIAX, has an expense ratio of just 0.04%, which is incredibly low. Reinvestment. Most index funds automatically reinvest any dividends or interest payments back into the fund. This is called dividend reinvestment and is a great way to compound your returns over time. Long-term growth. Index funds are ideal for investors with a long-term horizon. While the stock market can be volatile in the short term, historically, the stock market has always trended upward over the long run. An index fund allows you to take advantage of this steady growth while minimizing the risk of individual stock selection. How ETFs work. ETFs, on the other hand, work similarly to index funds. but with more flexibility. Key points: traded like stocks. The biggest difference is that ETFs are traded on an exchange just like individual stocks. You can buy or sell an ETF anytime the market is open, and the price changes in real time. This gives you more flexibility compared to index funds, which only trade at the market's closing price. Lower minimum investment. With ETFs, you can start investing with the price of a single share. Some ETFs can cost as little as $50 to $100 per share, whereas index funds often have minimum investments of $1,000 or more. More tax efficient. ETFs tend to be more tax efficient than index funds due to their structure. Because ETFs don't need to sell securities to meet redemption requests, as index funds do, they avoid triggering capital gains distributions. This makes ETFs a better choice for taxable accounts if you're looking to minimize taxes. Dividend reinvestment. Just like index funds, many ETFs also offer dividend reinvestment programs, allowing you to automatically reinvest any dividends earned from the underlying stocks. Index funds versus ETFs. Key differences. Let's dive deeper into the differences between these two types of investment vehicles. Trading flexibility. Index funds can only be bought or sold at the end of the trading day after the market closes. ETFs can be bought and sold throughout the trading day, just like regular stocks. You can also use limit orders, stop orders, and margin trading with ETFs, providing more flexibility for active traders. Liquidity. Index funds. Liquidity is less flexible because they only trade once a day at the closing price. ETFs, highly liquid since they can be traded anytime during market hours with real-time prices. Fees. Index funds usually have a slightly higher expense ratio compared to ETFs, but are still very affordable, typically between 0.05% and 0.25%. ETFs often have lower expense ratios, sometimes as low as 0.03%. However, you may incur brokerage fees when buying and selling, depending on your platform. Tax treatment. Index funds. They might distribute capital gains to investors at the end of the year, which could result in a tax burden. ETFs, generally more tax efficient due to the in-kind creation and redemption process, which avoids triggering capital gains. Dividend payouts. Index funds typically pay out dividends quarterly, which can either be taken in cash or reinvested. ETFs. Similar to index funds, ETFs also pay dividends, but the payout frequency and how they're handled depend on the ETF, audience engagement. Now that you know how they work and the key differences, I want to hear from you. Which one do you think fits your investing strategy? Are you leaning towards index funds for their simplicity and long-term growth? Or do you prefer the flexibility and tax benefits of ETFs? Drop your thoughts in the comments below, and let's discuss. Conclusion. So, to recap, both index funds and ETFs are fantastic tools for passive investors. If you're someone who wants to make long-term investments with minimal management and low fees, index funds could be the right choice. If you want the flexibility of buying and selling throughout the day, or if you're investing in a taxable account and want tax efficiency, ETFs might be better. Whichever one you choose, remember that the most important thing is to start investing. The earlier, the better. If you found this video helpful, don't forget to like, subscribe, and turn on notifications for more deep dives into investing. Also, make sure to leave a comment with your thoughts on index funds and ETFs. I'd love to hear your opinions. Until next time, happy investing.